When interest rates rise, some companies thrive while others go bankrupt. The difference is often one ratio. A company with 10 times interest coverage can see its earnings drop 90% and still make every interest payment. That ratio tells you how much cushion exists between operating profits and debt obligations. Interest coverage is earnings before interest and taxes divided by interest expense. If a company earns $500 million in operating profit and pays $100 million in interest, its coverage is 5 times. For every dollar of required interest, the company earns $5. Unlike total debt or debt to equity alone, coverage shows whether a company can actually handle what it owes from current operations. The formula couldn't be simpler, but it reveals something critical about financial health that most investors overlook. Debt isn't inherently bad. Companies borrow to grow, invest, and create value. But interest payments don't pause when business slows down. A company must pay its lenders regardless of how the quarter went. Coverage tells you how much room exists before that obligation becomes a problem. A company with 10 times coverage can absorb a severe earnings decline and keep paying. A company with 2 times coverage has almost no margin for error. One bad quarter and they're scrambling. Benjamin Graham and David Dodd made this case in Security Analysis back in 1934. They insisted that a company should earn several times its interest requirements to provide an adequate margin of safety. Their fixed charge coverage test was one of the earliest quantitative screens. Nearly a century later, the logic hasn't changed. The thresholds are well established across the financial industry. Above 10 times is very strong with minimal debt risk. Between 5 times and 10 times is healthy with a comfortable margin. Between 3 times and 5 times is adequate but requires monitoring. Below 3 times is a warning sign with limited flexibility. Below 1 times means the company can't cover interest from operations, which is distressed territory. Investment-grade bonds typically require coverage above 3 times, and banks scrutinize anything below 5 times when making lending decisions. Edward Altman's 1968 study on bankruptcy prediction found that operating earnings relative to total assets was among the strongest predictors of default. His Z-score uses earnings before interest and taxes divided by total assets as one of 5 key variables. Interest coverage and earnings before interest and taxes-based ratios measure the same underlying reality. Companies that generate strong earnings relative to what they owe are less likely to go bankrupt. Altman's work and decades of subsequent research confirmed that earnings-based metrics reliably separate financially healthy from financially distressed companies. Multiple studies have shown that coverage below 3 times dramatically increases default probability. When the Fed raised rates in 2022 and 2023, the difference between strong and weak coverage became vivid. Companies with low coverage felt immediate pressure as interest costs increased while operating profits stagnated or fell. Some couldn't refinance maturing debt. Some defaulted. Companies with strong coverage absorbed the rate hikes without breaking a sweat. They had room to maneuver, and many emerged stronger as leveraged competitors folded. NVIDIA currently sits at 446 times coverage, and Microsoft at 54 times. Both could pay off all their debt from a fraction of a single year's profits. Alphabet and Apple have net interest income that exceeds their interest expense, so traditional coverage ratios don't meaningfully apply to them. Screening for the strongest balance sheets requires more than just a coverage floor. We need to combine the ratio with leverage and profitability metrics to find companies that use debt strategically, not just avoid it entirely. A company with zero debt has infinite coverage, but that's trivial, not impressive. Here's our interest coverage screen with quality filters built in. We're pulling from financial ratios for coverage and leverage, then joining key metrics for profitability and market cap. The coverage floor of 5 times means earnings can drop 80% and the company can still service its debt, well above the investment-grade bond requirement of 3 times. The debt-to-equity range between 0 and 1.5 does 2 things. The lower bound excludes companies with negative equity, which signals distress, and the upper bound caps leverage at 150% of equity to avoid over-indebted firms. Return on equity above 8% ensures we're finding good businesses, not just companies with light debt and mediocre profitability. And the billion-dollar market cap floor keeps us in names with reliable financial reporting and normal capital markets access. Each filter addresses a distinct failure mode. Without the leverage band, the screen fills up with companies that simply avoid debt. Without the profitability floor, You get financially conservative but operationally mediocre businesses. The coverage threshold itself sets a higher bar than the 3 times bond covenant requirement, because we want healthy companies, not just survivors. NVIDIA tops the list at 446 times coverage with debt to equity of just 0.07 and 104% return on equity. Vertex Pharmaceuticals follows at 321 times with debt to equity of 0.21 and 23% return on equity. Microsoft sits at 54 times with 34% return on equity and debt to equity of 0.32. Service now at 101 times with 15% return on equity, and Costco at 73 times with 29% return on equity and debt to equity of 0.26. The top of this list is dominated by large tech companies with strong cash generation, but the more interesting names are in the 10 times to 30 times range. Those are companies that actually use debt as a strategic tool rather than simply avoiding it. They borrow when rates are favorable, invest in growth, and maintain coverage well above the danger zone. That's the pattern this screen is designed to find. No screen is perfect, and this one has 3 specific blind spots. Coverage is a snapshot, and snapshots lie. A company can show strong historical coverage while earnings are actively declining, which means today's comfortable 10 times can become next year's uncomfortable 3 times if profits are falling. The screen can't see that trajectory. It also doesn't distinguish between debt types. Short-term debt that needs refinancing in 6 months is far riskier than long-term fixed-rate bonds maturing in 2040. But both produce the same coverage ratio. The maturity profile matters enormously, and this metric ignores it entirely. Near-zero debt creates another distortion. A company with $100 billion in earnings before interest and taxes and $500 million in interest expense shows 200 times coverage. But that's not meaningfully different from 15 times at a company with prudent leverage. The number is technically correct but practically useless for comparison. And the screen naturally overweights tech and healthcare while underweighting financials and utilities, creating an implicit sector bet you should be aware of. The interest coverage screen is live on CetaResearch.com. You can adjust the coverage threshold, change the leverage range, and run it against any exchange in the data warehouse. Link in the description. In the next video, we backtest this strategy across 25 years and 13 exchanges to see whether strong coverage actually protects you during rate hikes and credit crises. Subscribe so you don't miss it.